Hey everyone, and welcome to today's Explainer. We've got a fantastic deep dive lineup for you. Today, we're cutting through the noise to demystify some really fascinating moves by three heavyweights in the fintech space: Robinhood, eToro, and Sezzle. We're going to break down their latest data to prove one absolute, undeniable rule. At the end of the day, underlying business fundamentals dictate success, no matter what the daily headlines are screaming.
To really wrap our heads around this, let's actually step outside of finance for a second and look at Hollywood. Take the recent Michael Jackson biopic. Critics absolutely tore it apart. It got a dismal 39% on Rotten Tomatoes. If you just read those reviews, you'd think, wow, massive flop, right? Well, no. Look at the box office. It raked in over $577 million worldwide in just 3 weekends. People packed the theaters anyway. It perfectly illustrates a core truth. When the underlying reality, in this case, massive audience demand, is undeniable, public perception and critical noise kind of just fade away. And honestly, fintech is telling us the exact same story right now.
So, here's our game plan for today. 1. The fundamentals always win. 2. Robinhood's pre-IPO push. 3. eToro's crypto disconnect. 4. Sezzle's clean credit reward. And finally, 5. The bottom line. Let's get right into it.
Starting off with part 1, the fundamentals always win, overcoming the noise. Our whole premise here is simple. Public perception or immediate stock reactions can look brutal on the surface, but if the underlying math of the business actually works, you're going to win. And it's super interesting to see how a company like Robinhood is taking that underlying strength and using it to massively expand their horizons into private markets. They're basically taking their core mission of democratizing finance and pushing it further than they ever have before. That brings us to part 2, Robinhood's pre-IPO push, going back to the venture well. So Robinhood just filed a draft registration statement with the SEC for something called Robinhood Ventures Fund 2, or RVI2. This is a brand new, closed-end fund aimed straight at early and growth stage private startups. Now, why is this such a big deal? Well, historically, getting a piece of pre-IPO equity meant you had to be an ultra-wealthy accredited investor or some massive VC firm. But Robinhood is building a direct on-ramp for everyday retail investors to tap into these high-upside, early-stage companies, especially in hot sectors like AI and fintech. Of course, early-stage investing is risky. Valuations are all over the place, liquidity is super tight, and honestly, sometimes a startup is just a fancy pitch deck in a dream. So you might be asking yourself, why is Robinhood taking on this kind of risk right now? Well, take a look at their first fund, Fund I. That portfolio gives us all the context we need. Fund I holds stakes in 10 late-stage absolute heavy hitters. We're talking massive names: OpenAI, Stripe, Databricks, Revolut, and Ramp. But here is the real kicker: 119%. Robinhood's Fund I has returned a staggering positive 119% over the past 12 months. When your first venture fund literally more than doubles in value in a single year, pitching a second, maybe slightly riskier fund, well, it basically pitches itself. The pure, undeniable math of their past performance gives them all the leverage they need to expand. And honestly, the strategic logic here is rock solid. By launching RVV, Robinhood is heavily diversifying their own revenue streams, so they aren't just relying on transaction-based trading commissions. Plus, it massively deepens customer engagement by offering something completely unique, all while perfectly extending their mission to democratize finance. The big takeaway? They are taking an undeniable track record and using it to unlock private market wealth generation for the everyday retail investor. It's a bold move, but the fundamentals absolutely back it up. All right, moving on to part 3, eToro's crypto disconnect, surviving the drought. Now this perfectly highlights the crazy contradictions we sometimes see in the markets. Look at eToro's Q1 2026 results. They absolutely crushed their estimates. Adjusted earnings per share beat consensus by 28%, hitting 91 cents. Net income surged 37% to $82 million. EBITDA shot up 35% to $109 million. I mean, objectively speaking, these are fantastic numbers. But wait, the market inexplicably punished them, and the stock actually fell 7%. So what on earth happened? Well, here's your answer. The market completely panicked because crypto revenue fell right off a cliff. eToro took a brutal 38% year-over-year hit in crypto revenue, sliding from $3.5 billion in Q1 2025 down to $2.15 billion in Q1 2026. And it got worse in April, with crypto trades alone plunging 32%. The market basically hyperfixated on this one single metric, completely freaked out, and started selling, totally ignoring the overall health of the actual business. But here's the brilliant part. eToro's multi-asset model totally saved the quarter. See that huge 60% slice of their trading mix? That is all commodities. Extreme volatility in gold and oil drove commissions up so high that commodities made up 60% of their total trading mix. That's nearly 4 times the year-over-year growth. And this happened right on the heels of eToro launching 24/7 trading for select instruments. On top of that, their funded accounts grew 12% to over 4 million, and assets under administration went up 15%. So their core multi-asset engine is running beautifully, even when crypto takes a major stumble.
And, we really shouldn't count crypto out entirely just yet. eToro's CEO, Yoni Assia, was recently on CNBC and made a pretty bold prediction. He said Bitcoin will reclaim its all-time high of over $126,000 before the end of the year. If he's right about that massive crypto revenue drag, it completely vanishes. Pair a crypto rebound with their booming commodities business, and eToro's diversification strategy turns into an absolute powerhouse heading into Q3. Right now, the market just hasn't decided if it wants to price eToro on its actual solid business metrics or just blindly follow the Bitcoin chart. Let's shift gears to part 4, Sezzle's Clean Credit Reward, the power of a clean book. I want you to zero in on this number, 290. Specifically, we're talking about a 290 basis point rate reduction. For anyone deeply involved in finance or lending, you know that dropping almost 3 full percentage points on your cost of borrowing is an absolute game changer. This is the direct, tangible financial reward that Sezzle just scored from their lenders. Let's take a look at exactly what a squeaky clean credit book actually gets you today. If you compare their old terms from April 2024 to their new ones, their total commitment with Messro Alternative Credit literally doubled, jumping from $150 million to $300 million. Meanwhile, their interest rate nosedived from SOFR plus 6.75% all the way down to SOFR plus 3.86%. There's that 290 basis point drop. Plus, their advance rate ticked up from 90% to 92.5%. I mean, just 2 years ago, securing terms like this would have been a total fantasy for a fintech company. So how did Sezzle actually pull this off? Well, terms like that don't just magically happen. They are the direct reward for Sezzle's staggering Q1 growth and a pristine balance sheet. Gross merchandise volume hit $1.1 billion. That's up 37%. Revenue climbed 29%. Net income shot up 42%. But the absolute star of the show is their jaw-dropping 52.5% EBITDA margin. Not to mention scoring above an 80 on the Rule of 40, which perfectly demonstrates that rare balance of hypergrowth and actual profitability. They even raised their full-year guidance to $180 million in adjusted net income. Sezzle's lenders literally voted with their term sheets, and they voted based on these undeniable numbers. And the fascinating thing is, this isn't just an isolated incident for Sezzle. It highlights a massive industry-wide trend. Clean books win, period. In fact, we saw Ripple Prime lock down a $200 million debt facility on the exact same day. Fintechs that actually maintain clean, high-performing credit receivables are getting heavily rewarded with significantly cheaper capital. For Sezzle, this huge cost of funds advantage gives them an incredible amount of runway, which is absolutely crucial as they gear up to submit their banking charter application in mid-2026. And finally, part 5, the bottom line. Let's synthesize all of this. Let's bring it all together. Whether we're looking at Robinhood leveraging a phenomenal track record to unlock pre-IPO upside for everyday investors, or eToro using multi-asset diversification and a massive surge in commodities to weather a brutal crypto winter, or Sezzle proving beyond a shadow of a doubt that strict credit management directly unlocks cheaper financing, the underlying thread is exactly the same. The fundamental business math always dictates long-term success. It simply overpowers the immediate market noise or critical reactions. So as we wrap up, I really want to leave you with a provocative thought to chew on. When you look past the daily headlines, the panic selling, and all of the chaotic market noise, ask yourself this. How are you currently evaluating the true core metrics of the companies sitting in your own portfolio? Are you just reacting to the reviews, or are you actually looking at the box office receipts? Thanks so much for joining me on today's Explainer, and keep digging into that underlying math. See you next time.